Hello. Let me know anyone is there in the class. Anyone is going to join the class or not? Let me know, please. Santu Chaudhary. Okay. Yeah. People have joined. I'm starting the class. Already it's late, ma. I don't know why late. The next concept in your thing is that last in the previous class we have learned about the written portfolio according to the CAPM written and risk on portfolio based upon the CAPM, RFPL, single index model and all those things. Now we are going to move the portfolio evaluation methods. Ma, in these methods, that how we are going to evaluating the portfolio means with the help of mutual funds performance analysis, we will be evaluating the portfolio evaluation. So under that, you are having a different types of measurements, ma'am. So the first measurement is your risk adjusted return, rate of returns, and your Jensen's method, farmers methods, farmers net selective method, sharps and trenches methods. So under these portfolio evaluations, for your point of view, you are having a three methods, that is SP, TP, JP. That is nothing but your sharps method, Jensen's method, and the trenches measurement. So under that, the first measurement is your charge. You can expect the problems on these three methods, ma. Means you will be having a problem on this SPTP JP, that is called as a portfolio evaluation. Nothing but your performance of mutual fund evaluation. So under the Sharps method, this is a person who is invented this Sharps model in 1966, William Foreign Sharps. So he developed this measure of the portfolio performance that is going to be popular, which is called as the Sharps ratio. We can call it as. So he has been originally called it as a reward to variability ratios. In 1994, again he has revised this ratio to acknowledge that the risk-free rate of various with the time priority basis. So this revisions is going to give the value for the risk-free rate of return and is going to assume the constant over period time. So the following formula will be useful for the Sharps ratio. We can call it as the SP also, that is Sharps performance also, or Sharps ratio, that is SR. So the formula for SR is equal to Sharps ratio is equal to RP minus RF divided by risk on portfolio. So SR is nothing but your Sharps ratio. RP is your return on portfolio. Next, RF is risk-free rate of return, and the RP sigma P is equal to risk on portfolio or standard deviation of portfolio return. Okay, fine. This is the formula for your Sharps ratio, and I'll explain the formula, ma. I'll explain the problem. If you want, you can take the pick. Suppose that the 15 years annual return for the BSC index is 10% and the standard deviation is 18%. The annual return and the annual return on treasury bonds is 5%, and you are going to evaluate the performance of these portfolio manager with the following 15 years results. Okay, so here managers are three managers. Annual return they have given 13%, 17%, 18%, and the risk on portfolio, that is 0.11, 0.21, and 0.27. So all the information they have given. So we have to calculate the calculation of portfolio return with the help of the formula of Sharps ratio. Okay. So Sharps ratio formula, what is the Sharps ratio? RP minus RF divided by risk on portfolio. RP is written on portfolio. What is the return they have given for Anil? 13%. And for risk, RF, what is the risk-free rate of return? That is nothing but your RF is nothing but your treasury bonds. If you remember in the previous class with my notes, I have explained you people clearly. Okay. Hello. Hello.
Yes,
Anyone?
ma'am.
Okay. Thank you. Anyone, please give my response. I don't know. You people are there. Okay. So this is RP and RF. Okay. Fine. So RF is your risk-free rate of return. That is your risk-free means no risk, 0% of risk. Those are nothing but your government security. That is called as a treasury bills. They have given 5%. That is why we have taken 0.05. This is the Sharpe's ratio of Anil, 0.13 divided minus 0.05 divided by risk on portfolio, that is 0.1111. So if you calculate for Anil, Bhaskar and Chaitanya, we got the 0.72 for Anil and 0.05 for Bhaskar and Chaitanya 0.4. So three managers have exceeded the market as shown by the sharp ratios. So the best performance which has given by the manager is got Anil. He's because if you look at this 0.72, that is 72% of the returns he has been given by the Anil. So Anil as a Sharpe's ratio of his portfolio is the highest, though the annual return on the portfolio is managed by the manager Chaitanya were highest. Even though Chaitanya is having a higher rate of return, that is 18%, but still Anil has been grabbed the highest portfolio return. Okay, ma'am. This is found that the best portfolio is not necessary that one with the highest return. It is the risk adjusted rate of return which is more. So how we are managing the risk is more important compared to that of a market annual return. Got it? This is according to the Sharpe's ratio. Anybody wants to take pick, you can take the pick, ma. Is anyone is going to take the pick, ma? After finishing, please let me know.
No need to take pick, ma'am. We have textbooks.
Okay, you have these notes, huh? Good, very good.
Yes, ma'am.
That's okay. Good. Next one, Trences ratio, that is TP ratio, or we can call as a Tenses ratio. So this ratio was the first researcher who has computed the measure for the portfolio performance. He proposed the risk adjusted performance measure in 1965, and because the first researchers to provide the investor with the comprehensive measure of portfolio performance, which is going to look a risk into consideration. So tensions measures or the measure of index reward to volatility, we can call reward to volatility also, which is going to comprises the excess return of risk premium in the numerator and the beta for the portfolio. If you look at Sharpe's ratio is going to RP minus RF, risk on portfolio. Risk on portfolio. If you look at the Trences ratio, this is beta of portfolio. The same RP minus RF will be there, but here beta on portfolio will be there. So what is RP? That is RP, that is written on portfolio. RF is risk-free rate of return, and the beta of portfolio. In the Trences ratio, they have considered the market sensitivity. That is a difference will be there for the Sharpes and the Trences. So if you look at the formula question, suppose for the 10 years annual return for the NSE Nifty is 10% and the standard deviation is 18%. The average annual return on the treasury is 5%, and we are going to evaluate the performance of these portfolio with the help of the following 10 years. If you look at the questions, Ram, Robert and Rahim, they have given information, and the average return they have given and the beta also they have given. Simply in the place of risk on portfolio, we are considering the beta on portfolio. That's it. So RP is we know 10%, beta is we know 9. That is what is that? For Ram and Robert, 15% minus 5% divided by 1.0.5. Rahim 16 minus 0.05 divided by 1.20. So if you look at, we got the Trences ratio for the Ram 0.052, Trences ratio for the Robert 0.09, and the Rahim is 0.09. So it is observed that the portfolio that we have performed better on risk adjusted has not yet been given the highest total return. No one is having the highest total return. Why? Because here the beta is very high. Always your beta should be less than 1. But here they are having 0.9, 1.05 and 1.0. So that's why they have been having the high risk rate, high risk on their portfolio. Got it, ma? Yes, this is according to the Trences ratio. Next year's Jensen's ratio, or we can call it as a differential return, we can call it as a, so the formula for the Jensen's ratio is equal to RP minus RF plus beta into RM minus RF. So E is nothing but your error. If at all any error is there, we are going to take that errors. But most probably the error will not be there, or else we can say that expected return on market also we can say. Error we can find out in the single index model, but this error we are not going to consider in any return on portfolio, because naturally we are not going to have any kind of a error related thing. So if you look at the formula, return on portfolio minus RF plus beta into RM minus RF. What is RP? That is the return on portfolio. RF is your risk-free rate of return. Beta is your whatever the systematic risk which you have been performed on our securities. RM is nothing but your expected return on your market. This is the formula for your Jensen's ratio. If you look at the question for this Jensen's ratio, suppose the annual return for the market portfolio is 10% and it is the standard deviation is having a 18%. The average annual return on treasury bonds is 5%. You are going to require the alpha. We can call the Jensen's alpha also, we can say, for the portfolio management with the three portfolio managers, that is Naresh, Ramesh and Mahesh, and they have given this information. Simply we are going to apply in the formula RP, return on portfolio, plus return on portfolio plus RF minus RM into RF. If you apply in the formula, we got the values for 9.75, 10.50 and 11.25. So this is the combination of portfolio evaluation, or else we can call it as a performance of your mutual funds. So always, I don't know what is the pattern you are going to give. Always it is going to give the combination, that is calculate the return on portfolio they will give. If at all they'll give in the problem like that, you need to calculate Sharps, Jensen's and Trencer. SP, TP and JP you are going to calculate. Okay, ma? Yes, always they will give the combination of these portfolio. If you look at, you are having some examples here. The combination of the sets they have given. These are some of the examples they have given. Do you have my chart, ma? I have given my chart now, measurement of risk and return portfolio, single index, single risk and single return. Hello? I have given some formulas to you now. Do you have that
Yes,
formula?
ma'am.
Yes, na? So if you look at this, you are having the question like this. So go according to my formulas, ma. It will become a quite confusion if you look at this one. If you follow my formulas, it will be easy for you, because step by step process I have taken. Just take the question of this and you can calculate according to my solution. If you look at, I'll explain the question simply how you have to, how you are going to supposed to solve this particular problem. So if you have seen, you are given the following historical performance information on the capital market and the mutual funds. They have given the performance of the 10 years mutual funds and the 10 years mutual fund beta and 10 years mutual funds on return on market also they have given. So beta values they have given for the 10 years period and they have written given the mutual fund return on market also they have given, and return on the market index also they have given, and they have given the treasury bonds, that is your risk-free rate of returns. Okay. So with this, we have to calculate the reward to variability and reward to volatilities. So we have to go into calculate the SPTP, JP formula by using the things. So reward to variability is nothing but your Sharps ratio. What is the formula for Sharp ratio? RP minus RF divided by risk on portfolio. So RP, what is RP? That is written on portfolio, and RF. RF is nothing but your, these are all the things you need to calculate. Okay. And risk on portfolio is nothing but your standard deviation of your portfolio. So if you look at the standard deviation of mutual funds in the question directly, they have not yet been given any information, ma'am. In the problem, they have not yet given any information regarding any kind of a risk on portfolio, return on portfolio. If you look at my chart, I have given a chart for the single security risk and single security return with probability and without probability, risk free, risk on portfolio and return on portfolio. Okay. So risk on portfolio sigma 1 square x1 square plus sigma 2 square x2 square plus sigma 3 square x3 square plus 2 into sigma 1 x1 sigma 2 x2 correlation coefficient between 1 and 2. That is a formula I have given. If you look at the chart, you are having a chart with you, ma? Anyone is having a chart with you?
Yes, ma'am.
If you look at that, you can get the chart. So this is the formula for the beta coefficient n into summation xy minus summation y square divided by n whole square. If you apply this formula, either you can apply this formula or else you can apply my formula also, n into summation xy minus summation xy into summation n into summation x whole square minus summation x whole square. That formula also you can apply. Okay, if you apply this beta coefficient formula and you are going to apply all these things in the values, if you calculate the y values here, if you look at this y written on your mutual funds, y square, that is 3 square, 1.5 square and 18 square. If you calculate this one, you are going to get the y square summation. And if you apply this y square summation in this beta coefficient, you are going to get the beta. What is the formula for the Sharpe's ratio? RP minus RF divided by risk on portfolio. RP we know 11.05 and RF they have given the all the values, and risk on portfolio we have calculated. If we apply the Sharpe's model, we got the 0.54%. In the same thing, return on volatility ratios or Prences ratio, the formula is risk free RP minus RF divided by beta of portfolio. Here risk on portfolio we have to calculate, and here beta on portfolio we have to calculate. So here return on market index they have given, and x square we need to calculate. The return on market always indicated with x. So simply we are going to squaring this, that is minus 8.5 square, 4 square, 14 square, 18.5 square. All the things we need to calculate, and we are going to apply for the risk on market square. That is beta we are going to evaluate with the help of this formula n into summation x square minus summation x whole square divided by n whole square. If we apply these formulas, we got the beta risk on market, that is 8.06. And simply we are going to apply for the market index for the Sharpe's ratios and Prences ratio, RP minus RF divided by risk on portfolio, Prences ratio RP minus RF divided by beta on portfolio. So with the help of beta, we have calculated the Prences ratio 2.75, and with the help of risk of portfolio, we have evaluated the Sharpe's ratio 0.34. Okay, ma? Like this, they will going to give the formulas, combination of your portfolio. Okay, na? Always they'll give like this only. Combination only they will give, ma, not the single index. Yes, okay. So these are all the example for questions for your evaluation of portfolio performance. Okay. If you look at the last step of your portfolio analysis is your portfolio revision. So whatever the portfolio performance evaluation we have done according to the mutual fund performance, that is SPTP, JP method. So all those performance, whether we have been allocated according to the market or not, we are going to analyze with the help of portfolio revisions. So the portfolio revisions we are going to learn in the last unit. That portfolio revisions we are going to learn in the last unit. That is portfolio revision. So what is this portfolio revisions? It is going to arise in the process of whatever the portfolio which we have been measured or which we have been analyzed according to our market, that portfolio we have done according to our provisions, according to the risk and return or not. Example, if you are having a funds of 10,000 rupees and you have invested your 10,000 in 5,000 in A securities, 2,000 in B security and 3,000 in C securities. So all these funds have been performed very well, and you have evaluated the performance of your market with the help of using the portfolio evaluation performance, that is your SP, TP and JP, and you have got some certain returns on your portfolio. So all this written on portfolio, if you look at the previous question, I have given Anil, Ramesh, Suresh, and some of the example also I have given. So some people are not getting their uh, good return on their portfolios. If at all they are not going to incur any good return on their portfolio, what is the mistake they have been analyzed? They are going to analyze with the help of these portfolio revision. Okay. Yes, ma'am. So what is the need for this portfolio? Why there is a need? What is the main purpose for this portfolio revision? Means need to invest more. Need to investment. If I am going to get a good returns, definitely I am going to invest in a good returns. And changes in investment goal, definitely there will be changes. So if you look at the previous example, I said in a security I have invested 5,000 rupees and it has performed very well. So if at all it is going to perform very well in the coming years also, I'm not going to simply invest the 5,000 as usual. If it is going to perform very well, definitely I'm going to add some kind of a portfolio again to the A securities. And if it is any kind of reductions in the remaining securities, I'm going to do such type of a revision for that portfolio. That is called nothing but your changes in the goals. Fluctuations, if at all any fluctuation in the market is going to be done, if there definitely there will be a need for the portfolio revisions. Next, if at all any investor is going to any kind of expectations, if investor is expecting more or else he getting some fall for it down in the market, definitely it is not according to the expectation of investor, then he will be going for the portfolio revisions. And any kind of a microeconomical or macroeconomical changes is going to there, and any kind of developmental changes in the capital market, there is a requirement for the portfolio revisions. So how this portfolio revision is going to construct means, what is a conceptual framework for this portfolio revision means, here they will be involving the transaction cost, taxes, statutory stipulations, and the intrinsics, which is going to be its intrinsic difficulty, that is a true value. So transaction call, always the market is going to be involving the transaction cost for the exchanging of their or buying and selling of their shares in the market. So that will be leading for the transactional cost and any kind of a tax which is going to give an impact on the return on your investment, as well as the face value of your investment, which is going to give an impact again in the coming back to the intrinsic value of the portfolio, which is going to give an impact on the market. So this portfolio revision is going to quite difficult, and it will always taking the time consuming exercise. So this methodology is going to followed by the portfolio manager in order to reduce the risk as well as to hedge the risk, which is mostly helping for the portfolio investors. And any kind of a statutory stipulations, any kind of a stipulations in each and every country, they have been managing very well by the investment management companies as well as the mutual funds companies. So these institutions is going to be involved normally the gone, which is gone by the certain statutory stipulations, which is regarding by their investment policies. So these are the conceptual framework which will be there in your investment portfolio revision. So what are the strategies which you are going to adopting in your portfolio revisions? First strategies is that active revision strategies and the passive revision strategies. So if at all we are going for the portfolio revisions, we are having a two types of a revision process, that is called your active, and the next one is your passive. Active revision process, it involve frequently changes which is going to be existing in the portfolio over a certain period of time for maximizing the returns and minimizing the risk. So this active region strategy is going to help the portfolio manager to sell and purchase the securities on regular basis for portfolio revisions. This revision is essential, which is going to helping the portfolio analysis and portfolio selection over a period of time. And here the certain factors also going to be require affecting for this strategy. There's nothing but a demand and supplies, time, skill, resources. These are the certain things which will be affecting the active revision strategies. Next, passive revision strategies. It involves very rare changes which in the portfolio only under certain predetermined rules. So these predefined rules are known as your formula plans. So according to these strategies, a portfolio manager is going to take the changes in the portfolio as per the formula plans only. If at all he is having any kind of a plans, he will be then only he is going to going for the portfolio revisions. So the practitioners who for this passive revision strategies is going always believe in the market efficiency and homogeneity of expectation among the investors. This is about your active revision strategies and the passive revision strategies. Okay. So you can expect this active revision strategies and passive revision strategy for the short answer, and you can expect the formula problems for these SPTP and JP. That is nothing but your portfolio evaluation performance, mutual fund performance also we can say. Mm, no problems on this. Okay. Okay, ma. That is, this is okay, fine. This is not going to come for you. Okay. Portfolio for evaluation performance means only SPTP and JP, and the active and portfolio, you can expect questions. If you have any queries, you can ask me, ma. So we are having lots of time. Any queries, you can ask me, ma. With this, we have completed the subject and I've covered all the things which you can expect in your problem in your exams, and I've covered the problems also. Risk on portfolio for single securities, written on portfolio for single securities with probability and without probability, written on portfolio for two security cases, risk on portfolio for two security cases, written on portfolio for three securities, and written on portfolio for three security cases. I've given the problems and I have given the chart also with the formulas. If you go through with my formulas, it will be easy for you. Please take the questions from your textbooks and try to solve according to my notes. It will be easy for you, easy understanding compared to the top these notes. If you have any queries, you can ask me, ma. Yes. Okay. CAPM written, single index model, Sharpe's model, Markovit's model, valuation of stock analysis, dividend capitalizations, price earning, two-stage model, one-stage model we have calculated. Anybody is having any doubts, you can raise, ma. As it is a problematic part, and I don't know, again, you are going to get a chance to ask the doubts or to raise a doubt because it's the last class. I'm waiting.
Yes, ma'am.
Any doubts you are having?
No, ma'am.
Clear with the problems, ma?
Yes, ma'am. If you will practice, it will be okay, ma'am.
It will be okay. You have to practice, ma. Why? Because problems will be there, and written on portfolio, risk on portfolio. You have to practice. You have to remember those formulas. If you remember those formulas, only you are going to be solve the problems. And for this unit, you can expect SPTP, JP. Definitely, you are going to expect these problems. Risk on portfolio, that is mutual fund performance portfolio. Also, we can say
Okay.
okay.
Okay,
And
ma'am.
either you can expect CAPM, single index model, or whatever you get. Valuation of common stock also we have completed in the last Sunday, if I'm not wrong. Last Sunday only we have completed. Have you taken that notes?
Ah, yes, ma'am.
If you don't, if you are clear, you can leave the class, ma. If you don't have any doubts, no doubts means you can leave the class. Mm. Uh, Good afternoon, sir or madams. So by today, I have completed my entire syllabus, sir, and I have discussed with the students also regarding any doubts, anything else. So I had a two-way communication with the students also, and they have not yet posted any queries also. And I've covered the problematic parts, whatever the things they are going to expect in the exams. So all the problematics I have covered, sir. So this is the last session. So that's why I'm giving. So I'm leaving the class, sir. Thank you so much for providing this opportunity. Thank you.